Hi everyone. Welcome to our strategic session. Today, HDIN Research presents a comprehensive comparative analysis between AMD and Intel as of early 2026. We will examine how both firms are navigating the AI-driven structural shifts in the semiconductor landscape and the resulting impact on their financial and operational stability. Starting with the executive summary, we characterize the current environment as an AI tectonic shift. While both companies are pivoting toward high-performance compute, their strategies have diverged. AMD is successfully leveraging its asset-light model to capture AI system integration growth, while Intel is undergoing a massive transformation into a national champion via its IDM 2.0 initiative. We look at the core business models. AMD's fabless approach optimizes for return on equity and operational flexibility by utilizing external foundries. Conversely, Intel is doubling down on its, system foundry model, deploying significant capital into R&D and manufacturing to regain process leadership and secure domestic supply chains. Supply chain risk remains a critical variable. Our analysis shows that AMD maintains a high exposure to geographic concentration in Taiwan, which poses a resilience challenge. Intel, through its integrated model, offers a more globally distributed manufacturing footprint, though it faces its own complexities in managing multi-regional fab operations. Turning to the financials for FY 2025, the data reveals a stark contrast. AMD's gross margin reached 50%, reflecting strong data center demand. Intel's margins, however, were pressured by significant impairment charges and the high costs associated with its foundry transition. While Intel remains the larger entity by revenue, the market currently favors AMD's capital efficiency. Slide 6 details the impact of geopolitical export controls. A key case study is the AMD MI308, which saw an $800 million impairment due to regulatory shifts. We also note that Intel's 24% revenue exposure to certain international markets makes it highly sensitive to changes in trade policy and licensing requirements. Intel has strategically aligned its growth with national industrial policies. By securing substantial funding via the CHIPS Act, and participating in the Secure Enclave project, the company is effectively de-risking its long-term infrastructure investments through government-backed partnerships. For AMD, the acquisition of ZT Systems marks a pivot toward vertical integration. By retaining the design business and spinning off the manufacturing arm, AMD is positioning itself to provide hyperscalers with full-stack server solutions, directly challenging the dominance of traditional ecosystem leaders. In the client segment, the AI PC is the new growth engine. AMD was an early mover with integrated NPUs, but Intel is leveraging its 18A node and massive install base to regain momentum. We expect 2026 to be the year where the architecture war between Ryzen AI and Core Ultra reaches its peak. Data center trends clearly favor AMD's EPYC lineup, which continues to gain share in cloud hyperscale environments. Our projections show a consistent CAGR of 32%, driven by superior performance per watt metrics compared to legacy x86 offerings. Comparing AI accelerators, AMD's Instinct series is currently winning the software platform war through the maturation of ROCm. Intel's Gaudi series has faced challenges, resulting in inventory provisions, though their next-generation Crescent Island platform aims to address these performance gaps. To maintain liquidity during its turnaround, Intel successfully executed the Altera divestment. This move provided a necessary capital buffer, generating over $5 billion in gains to fund the ongoing construction of advanced 18A fab facilities. Our SWOT analysis for AMD highlights its strengths in GPU architecture and high margins, countered by its high dependency on a single manufacturing partner and a still-growing software ecosystem. For Intel, the core strengths are its domestic manufacturing capacity and the CHIPS Act support. However, its high debt-to-equity ratio and the technical execution risks of the 18A node remain significant hurdles for the management team. Visually, the radar chart shows that while AMD leads in capital efficiency and compute performance, Intel maintains a higher score in geopolitical sovereignty and supply elasticity due to its internal manufacturing capabilities. Deconstructing the return on equity through DuPont analysis, we see that AMD's superior ROE is driven by profit margins and asset turnover. Intel's ROE remains under pressure as it carries a much heavier asset base and higher leverage during its transition phase. Market sentiment has diverged as well. AMD trades at a significant premium to book value, reflecting growth expectations. Intel is trading below its book value, indicating that the market is still pricing in the risks of its capital-intensive foundry strategy. Moving to our recommendations, AMD must further diversify its fabrication partners to mitigate Taiwan risk. Intel must secure a major external foundry customer by the end of 2026 to validate its IDM 2.0 strategy. Investors should view AMD as a growth play and Intel as a policy-backed turnaround play. Geographic exposure remains a dual-edged sword. Intel's 24% exposure to the China market is a, quote, critical impact zone regarding trade frictions, while AMD's international sales dependency requires careful navigation of global regulatory environments. We look at 3 scenarios for 2030. An Intel rebirth as the Western TSMC, continued AMD hegemony in hyperscale compute, or a broader industry disruption by custom ARM-based chips from cloud providers themselves. Thank you for your time today. For deeper content or bespoke market research reports, please reach out to our team at sales@hdinresearch.com. We now open the floor for any questions.